Good afternoon, and welcome to day 2 of Energy Finance 2020 online. I'm Sandy, Sandy Buchanan, Executive Director of the Institute for Energy Economics and Financial Analysis, coming to you from Cleveland, Ohio. Our session today is on accelerating the global capital shift away from fossil fuels. Throughout the conference, we'll be live tweeting, so if you'd like to join that discussion too, there's a hashtag at hashtag IEEFA 2020. Our moderator today is Justin Guay. Justin is the Global Strategy Director for the Climate Program at the Sunrise Project. He was previously a program officer for coal programs at both the Climate Works Foundation and the Packard Foundation, and served as the Associate Director of the Sierra Club's International Climate Program. And now let me turn this over to Justin to get us started.
Thanks, Sandy. Really excited to be here with everyone today and want to welcome the audience for what I'm sure will be the most exciting session of the entire conference because I'm getting to moderate it. But we are really excited about the topic of the session, the global capital flight and the transition away from fossil fuels. We'll be hearing today from Tim Buckley, Director of Energy Finance Studies at IEEFA. Tim is a financial analyst covering global electricity markets, with a focus on India and Greater Asia. We'll also be hearing from Heffa Schücking, founder and executive director of urgewald. Heffa is a former Goldman Prize winner and a leading NGO campaigner in Germany and around the world focused on transitioning global finance beyond fossil fuels. So we have two incredible speakers today, lots of great content. Before we get started, I just wanted to note for the audience that if you have any questions for me or for the speakers, we'd love to hear them, and you can upvote them to make sure that your favorite questions get asked. On the right-hand side of the live feed, there's a chat box with 3 tabs. The first tab is labeled Chat, is a live discussion where you can share your opinions and reactions to the session with other audience members. The second tab is labeled Questions. This is where you should type in the questions you want the speakers to answer. And if someone else has asked a question you like, again, make sure you click the thumbs up, and that question will be pushed to the top of the list. So with that, without further ado, let's jump into the session.
Good afternoon. I'm Tim Buckley from IEEFA, based in Sydney, Australia, and my market focus is South Asia and Australia. Everyone has been consistently surprised by the magnitude and rate of deflation in renewable energy, and more recently, the surprise has been on the magnitude of deflation in the battery sector and the electric vehicle sector. So deflation is, to me, the absolute driving factor on why this energy system disruption is inevitable. It's accelerating and it's catching everyone by surprise. Now, we saw in April, in the middle of the global pandemic, a 15% lower solar tender price of just $13.50 per megawatt hour, down 15% on 4 months previously, and that tender was awarded in Abu Dhabi. A 1.5 gigawatt solar tender, setting yet another record low, and it's every couple of months we see the record low being repeatedly smashed. So ongoing deflation, I would expect that to continue for at least the next decade. There is no way once we get to grid parity it stops. It will actually just smash straight through grid parity and continue. And there's probably no better voice on this than, in fact, came out last month in India. Gautam Adani, probably the most powerful corporate leader in India, put out an op-ed on LinkedIn, and he made the observation, which I totally agree with, that solar deflation has been in the order of 99% in the last 40 years, and that he expects it to be another 99% down in the next 40 years, such that variable renewable energy will be effectively free within the next 40 years. And to me, that is the absolute game changer that is disrupting the energy markets. And that's the point that financial markets are absolutely grappling with and realizing that this is an end game that is inevitable, it's technology driven, and it's coming much faster than anyone expected. Our I mentioned Gautam Adani. Anyone who's spoken to me in the last 8 years would know I've been at odds with him on a number of issues, particularly with one thermal coal mine that he's trying to build in Australia. It's worth observing that he is also now the second largest investor in renewable energy in India. And in fact, only 2 weeks ago, he won a $10 billion new solar contract. So he has totally committed his own personal capital and the wealth of the Adani Group to driving the transition. But unfortunately, he's a billionaire, he's technologically agnostic, and he will invest wherever he thinks he can make money. So unfortunately, a decade later, he's still pursuing his thermal coal mine in the Galilee as well. Now, we've also seen that the IEA has clearly noted a 2020 will be catastrophic for the thermal power sector, for the gas and oil sectors, with high single-digit declines in volumes matched with 50+% declines in prices. And the one bright spot that the IEA acknowledges is that renewable energy continues to grow, and, a second bright spot, global emissions continue to fall as a result. So to me, the global pandemic is catastrophic, but it is also a key global catalyst for change, a change in mindset and a change in financial stance. So moving to finance. Finance, I think, is playing an absolutely pivotal role, and there's probably no better announcement than the one from BlackRock in January of this year, where Larry Fink, the CEO, founder of BlackRock, announced that there was a fundamental reshaping of finance and that BlackRock was acknowledging it belatedly, and they were moving to deal with it. Now, they could move a lot faster, but to me, it's really important to acknowledge they've made 5 critically important steps in January. And in fact, in a shareholder update that they released last month, they've demonstrated significant progress. Is it everything we need? Categorically not. Are there another 50 steps they need to make? Absolutely. But it's our analysis of finance that once a corporate starts moving, they then start having to revisit those statements, those commitments, because the reality is the first commitment's never properly aligned with the Paris Climate Agreement. And so you invariably see a lot of the loopholes removed and the progress accelerates from here. And so that's my expectation with BlackRock. So I'd rather acknowledge the success of having them make 5 significant moves, and that has certainly proven to be a catalyst for other financial organizations around the world. So in 2020, we have seen 39 globally significant financial institutions announce new or updated coal exit policies. Now, the slide in front of you says 38, but in fact, just in the last 5 minutes before making this recording, there was the 39th announcement. Hester, one of Australia's biggest super fund owners, announced they have accelerated their divestment from thermal coal and that they have committed to a net zero portfolio globally by 2050 and a 33% reduction as an interim measure by 2030. So a significant step by a significant asset owner in Australia. That's the 39th announcement year to date. That run rate's almost double the rate that we saw last year. So to my way of thinking, the snowball is rapidly accelerating down the hill and the laggards are starting to move. So to me, it's an inevitable outcome. And when finance shifts, the global energy market will have to shift as a result, or will shift. Now, it's not just global finance that's actually moving. We've seen some amazing statements from the European oil and gas majors in the last 4 months. We've seen it kicked off by Bernard Looney, the incoming CEO of BP, announcing a pledge to net zero carbon emissions by 2050 or sooner, and a whole series of steps, in fact, 10 major steps. And the following day, he exited 3 US fossil fuel lobby groups to mark that he means to demonstrate progress as fast as he possibly can. He needs to bring the entire company with him. But to me, what Bernard Looney at BP said was critically important. We've seen it before with BP, so obviously we need to make sure he delivers. But at the end of the day, the finances and the technology are such that 20 years after BP first announced their shift to zero emissions, I think this time they mean it. And it's interesting that we've seen Total, we've seen Shell, we've seen Repsol of Spain, we've seen Eni of Italy, we've seen Equinor of Norway. There's a whole series of pledges by leading oil and gas majors across the European market. Now, that becomes critically important because those European oil and gas majors were committing to spending hundreds of billions of dollars just this decade on fossil fuel developments. And now they're rapidly pivoting towards renewable energy. So that will deprive the fossil fuel industry of hundreds of billions of dollars of capital, and it'll actually drive capital in the right direction. So obviously there's a long way to go, but these first steps are pretty serious steps by oil and gas majors. And so it's no longer just talking about divestment of coal. What we're now starting to see is that the landscape is accepting that we actually need to move on all fossil fuels in order to get the net zero by 2050 and an alignment with the Paris objective of trying to limit global temperature rises to 1.5 degrees. And as soon as you start making that commitment, firms realize their policy statements are very hollow, and therefore they end up having to revise, upgrade, and build on those policy statements. And it's that building that is critical. That's what we've seen in the last 2 years in finance, and now that's what we're starting to see with the European oil and gas majors. Who knows, maybe even Exxon by the end of this decade will stop being a laggard. Probably not. Now, talking of laggards, moving to accept the reality, Japan's TEPCO this month has announced an $18 billion pledge to invest in renewable energy this decade. Now, TEPCO is Australia's biggest buyer globally of thermal coal. It's the biggest buyer of Australian LNG, and it has just announced a strategic shift into renewable energy. Now, to my way of thinking, we've got the global oil and gas majors moving, we've got the global financial majors across insurance, across banking, and across asset owners and asset managers, and the utilities are likewise moving. So to me, that's the trifecta. That will accelerate this shift even faster than we've seen to date. There's probably no better market than, in fact, America to illustrate the magnitude of the technology disruption. The American coal consumption year to date in 2020 is down 27%. Year on year, year to date. That's no orderly disruption over a decade or two. That is a terminal outcome in the next couple of years. And so we would at IEEFA expect that the American electricity market will be entirely out of coal-fired power generation by the end of this decade. And it's interesting that the most successful utility in America, the largest utility in America, NextEra Energy, is actually 100% on side with that forecast. They've in fact been making that forecast for a year now, saying that the US power system will have zero presence from coal-fired power generation by the end of this decade. Nuclear will go next, and then beyond that, gas will go after that. Why? Because wind and solar are already the low-cost source of supply, and even when you add in the cost of peaking power or firming, the costs are already 100% on side. So it's pretty inevitable, it's pretty dramatic, and the US is probably the world leader in this shift. The UK is actually demonstrating, the country that probably first moved into coal centuries ago. Now the UK has actually had 67 days in a row coal-free in 2020. It's been an amazing shift. The speed has caught absolutely everyone by surprise. And what we've seen is a very interesting follow-on trend, which is that as coal's moved to zero, gas has also lost share. So this chart from Ember in the UK illustrates that gas share of the UK electricity market actually peaked back in 2016, and it's declined by 25% already. So it's dropped from 44% to 33% in the last 5 years at the same time as coal's been going out the door. So this transformation is impacting all fossil fuels. It's not just coal, and the momentum is building. To finish with three charts that to illustrate what I'm saying is not just IEEFA's view, it's in fact borne out by what the global financial markets are showing. NextEra of America is a brilliant example of where shareholders have been consistently rewarded for 15 years in a row with massive sustained outperformance and low risk. This is just the outperformance in the last 2 years. So the stock is up 47%. It's up 4 times what the American market is in 2 years. And NextEra prides itself on being the world's largest investor in renewable energy. So it's staggering the amount of money they're investing in this technology transformation. And they're doing it because it is the right thing for their shareholders. Now, flipping that around, the red is Exxon. Exxon is investing in fossil fuel reserve expansions. Exxon's investing in stranded assets, and Exxon's shareholders are getting it in the absolute neck. Not just in the last 2 years, but in the last decade. So Exxon in the last 2 years down 43%. So a staggering amount of shareholder wealth destruction. And that is ultimately why global financial institutions are moving. They don't want to keep throwing their capital away by backing fossil fuel laggards. So it's not a moral imperative, it's actually a fiduciary duty of global investors to actually divest from fossil fuels. Second last slide, the performance of Peabody Energy. I mean, again, anyone who's been talking to me for the last 8 years would know I love this chart. I mean, we used to use it all the time. We had to stop for a year because Peabody went bankrupt. It phoenixed back in 2017, re-IPO'd, shrugged off all its liabilities, screwed its workers. Now it's back in financial distress again, down 93% in the last 2 years. And so very much in financial distress already, headed towards bankruptcy for the second time in 5 years. And Peabody has prided itself on being the biggest private coal mining company in the world for the last decade, and a lot of good it's done its shareholders. So to finish, I'll just emphasize that while IEEFA's focus over the last 8 years has been very much about coal, we've expanded our focus on fossil fuels more generally, and the financial markets are likewise now very much questioning the financial merits of fossil fuels in general. Stranded asset risk is very real, it's very present, it's an absolute wealth hazard. And let's just have a look at the share price performance of Chesapeake Energy. It is was the world's largest fracking company. At its peak, it had a market cap of $38 billion US, and in the last 2 years, its shares are down 99%. So it has destroyed enormous shareholder wealth, and it's in financial distress, and it epitomizes the entire US fracking industry. It's dragging the US banking sector down dramatically with $500 billion of sour loans across the oil and gas sector in the US. That's the number one problem for the US banking system this year, probably bigger than the pandemic in terms of its impact. And Chesapeake is probably a perfect example of how wealth destruction is driving financial institutions to actually take a moral stance and uphold their commitments under the Paris Climate Agreement. So that is great news in terms of the inevitable technology-driven pivot towards sustainable zero emissions energy systems of the future. Thank you.
Hi, my name is Heffa Schücking, and I'm the director of Urgewald, an NGO that's been campaigning on coal and the finance industry since 2011. I want to begin my presentation by sharing 2 numbers with you. Investors representing US dollars 11 trillion in assets have already taken significant steps to divest the coal industry from their portfolios. 11 trillion sounds like a lot, right? But here's the other number we have to consider. US dollars 111 trillion. According to PricewaterhouseCoopers, that's the size of global assets under management. So how can we move the whole 111 trillion? Not only out of coal, but also out of oil and gas. And how do we do that quickly? Spoiler, I don't have a blueprint for you, but I do have 5 lessons that I believe are crucial for accelerating the shift away from fossil fuels. Lesson number 1, we need to change the way we think about the finance industry. We're all used to seeing financial institutions as extremely powerful entities, and that's the image they cultivate through their bank towers and the astronomical salaries for their top management. But this masters of the universe stuff, it's just an illusion. If we want to accelerate, it's best to think about the finance industry like this, as a relatively uninformed group with strong herd behavior. And the easiest way to move the herd is to pick the right target animals. Get them to shift and the herd will follow. But careful, this isn't just about moving the biggest players. This is about understanding the dynamics within the herd and recognizing that there's a kind of natural order in which it becomes much easier to move these institutions. Lesson 2, information is power. When urgewald was campaigning on the coal investments of the Norwegian government pension fund in 2014 and 2015, we had a revelation. Up until then, we assumed that financial institutions know exactly who the coal industry is. Well, they don't. Most investors have no idea which percentage of a utility's power generation is coal-fired or which companies are planning to develop new coal projects. And to be fair, this is not always easy to figure out. At first glance, no one would expect that a company called Limor Resources is developing new coal mines in Madagascar. And if you go on the webpage of Shine Energy, you'll see that the company's motto is helping Australia transition to a low emissions future. You'd have to dig much deeper to see that Shine Energy is planning to build a $2 billion coal power station in Queensland. Our revelation was that NGOs should grab the high ground and not leave it up to investors or to business information providers to define who the coal industry is. This is why urgewald began compiling the Global Coal Exit List, a public database of statistics on companies operating all along the thermal coal value chain. It covers not only coal miners and coal power companies, but coal traders, coal transporters, coal to gas companies, coal plant manufacturers, the whole shebang. And what we've seen is that the availability of good information has a huge impact on the finance industry's willingness to act. Remember the 11 trillion number I mentioned at the beginning? These are investors who are using one or more of the 3 divestment criteria promoted by the Global Coal Exit List. Data plays an important role in shaping the policies financial institutions adopt. And that's why urgewald is now planning to build GOGLE, the Global Oil and Gas Exit List, to be published next year. Lesson 3 is short and sweet. Campaigning is what makes things happen. I'm not saying financial risk arguments aren't important, but the truth is it usually takes more than that to move financial institutions. Remember all the new coal policy restrictions Tim talked about? In almost every case, these were the result of hard-fought NGO campaigns all over the world. Reputational risk is still the single most important driver behind the stampede of new coal policies. We now need to create the same kind of stampede on oil and gas. Lesson number 4, don't stop when the job is half done. What we've learned while campaigning on coal is that there's a huge difference between achieving a policy or achieving a good policy. So let's look at what a good bank policy on coal looks like. Francis Natixis is the 20th largest bank in the world. It long ago excluded direct project financing for coal plants and coal mines, and it has now moved to ban any type of corporate lending or investment banking for coal plant and coal mine developers. It also excludes all companies that generate over 25% of their revenues or power from coal. And it has announced it will phase out financing for all remaining companies that have coal activities by 2030 in OECD countries and by 2040 in the rest of the world. Now contrast this with the coal policy of Europe's largest bank, HSBC. It took HSBC about 5 years longer than Natixis to even rule out project financing for all new coal power stations. In regards to corporate finance, all HSBC's new policy says is, we will not provide financial services for new customers that generate over 50% of their revenues from coal mining. Now, there are 3 things wrong here. Number 1, where's coal power? Why is coal power not mentioned in this policy? Number 2, a 50% threshold only covers around 1/3 of the world's largest coal miners. And number 3, this policy anyway only applies to new customers. That means for HSBC's existing clients, it's just business as usual. This is what I call a bullshit policy. It won't shift capital, it won't get the job done. And HSBC isn't alone here. There are plenty of other financial institutions whose policies only cover coal mining. Think BlackRock or CalPERS, or that only cover coal power. Think UBS or ING, or that only cover stocks and not bond investments, or only apply to financial institutions' own accounts and not to the assets they manage for third parties. The creativity of the finance industry knows no bounds when it comes to putting loopholes into policies. The thing is, we don't have time for measures that are only addressing a small part of the problem. We need to set quality standards for policies, because if financial institutions don't get this right on coal, you can be certain they also won't get it right on oil and gas. 170 financial institutions have now adopted coal policies, and more are still coming up. So how do we navigate this policy jungle? Luckily, there's a new French NGO called Reclaim Finance, which has devised a fantastic online tool which analyzes all 170 policies. It assigns grades for each one, and you get a short summary of what the policy does and what it doesn't do. What I'm showing you here is, by the way, a sneak preview. The final tool will be published in September. The great thing is this tool will not only inform us, it will also inform financial institutions. Anyone who has ever attended school knows that peer groups have a huge influence on us. By making it easily visible what all the other finance guys are doing, Reclaim Finance's tool can help us speed up the policy race. Lesson number 5, the time for patient engagement is over. For years, we've heard financial institutions say things like, we prefer to stay engaged with our clients to help them transition towards a low carbon economy. But what happens if these clients are developing huge new oil reserves, building new oil pipelines, or bringing new coal plants online? What happens if these clients are threatening legal action against progressive climate legislation? What happens if these clients refuse to shut down their coal plants by dates that are in line with the Paris Climate Agreement? For most financial institutions, the answer is nothing much happens. Yes, they may have a talk with the company, write a critical letter, or even ask questions at a shareholder meeting. But they don't stop providing corporate loans, buying the company's bonds, or insuring its fossil fuel assets. So the company in question receives two contradictory messages. One is, we're not so happy with what you're doing. And the other is, here's the money to keep on doing what you're doing. And the money message tends to be louder than the engagement message. To be effective, engagement needs to go hand in hand with divestment, or at least be accompanied by a freezing of new investments. Engagement needs to be time-bound and connected with short-term actions on the side of the company. Pie-in-the-sky promises about becoming carbon neutral in 2050 won't cut it. We need to flatten the curve now. Otherwise, engagement becomes a trap where we end up missing all of the important climate deadlines. It's a profound change in dynamics when financial institutions like AXA or Natixis say to companies, our portfolio is going to be coal-free by this date. Here's our schedule of intermediate targets. If you want us to continue insuring you or to finance you, show us you're on track. Those were my 5 lessons. So now let's get financial institutions to adopt the phase-out dates that we need and put an end to fossil finance.
All right, thanks everybody, and thanks to our speakers. Those were some really excellent presentations, chock full of hearty goodness when it comes to the global transition away from fossil fuels. Now we're going to open up a moderated session for questions and answers. We have some really good questions that you all in the audience have been supplying, so we've been compiling all of those, and we have Heffa with us to help answer all of the really important questions you're asking. So I'm going to start with the big question for Heffa, which is, how has COVID and the subsequent financial crisis or economic fallout impacted all of the momentum that you and Tim just presented?
Okay, thank you, Justin, and thanks for the many, many questions we see here in the chat. I mean, the pandemic, it's clearly had a major impact. We've seen a collapse in oil demand, and for the first time ever, negative oil prices. If you look at corporate bankruptcies in the US, around half of those are happening in the energy sector. And we see even the oil majors like BP or Shell slashing millions of, billions of dollars off the value of their assets. And we're also seeing that the pandemic has thrown a wrench into many of the new sort of big projects that have been in planning, like Vaca Muerta in Argentina. And I mean, overall, it's reinforcing a trend that was already there. If you look 10 years ago at the share, the market value of energy companies for the S&P 500, they accounted for something like 15%. And even before the pandemic hit, the market value of oil and gas companies in the S&P 500, it was at 3%. So it's making clear how, how risky actually, it's reinforcing the perception of how risky oil and gas investments especially are for the financial sector. But at the same time, the pandemic also brings a danger. I mean, we see public money being used for bailout. If you think of the Federal Reserve's coronavirus bond buyback program, and yeah, it's, in summary, I think I'd agree with Tim here that the transition is inevitable, but if we want to ensure that it happens quickly enough, we have a hell of a lot of fights ahead of us.
Indeed. I would just say, as a little bit of additional color commentary, the thing that's really struck me through the crisis period and even beyond is that the momentum in terms of financial institutions announcing new exclusion policies and generally continuing to flee coal, and then of course oil and gas as well, has actually not only maintained, it's accelerated. So I think the latest figures from IEEFA and from Tim are that there's 136 globally significant financial institutions with a coal exclusion policy. And this year has been a record pace, even with the economic fallout. We've had nearly 2 policies announced every week in 2020. So while there are significant headwinds and there are a bunch of interventions that have been made by key governments around the world that are not helping the transition, they're slowing it down. I think the trend and momentum and direction of travel is quite clear in the financial sector and the private sector. But I wanted to turn to one of the more popular questions we had, Heffa, which you foreshadowed in your last answer, which comes from Kristen Shenham, which is that we are seeing countries, including the US and Canada, spending billions to prop up the fossil fuel industry in response to the current economic crisis. How will these policies or measures that are being enacted during this crisis period impact that global shift to renewables over the next decade?
Well, it's going to drag out the job of phasing out oil and gas and bringing in, I mean, turning our energy systems to 100% renewables. So it's a real problem. And I mean, it's not only different national governments, we're also very worried about multilateral development banks. I mean, if you look at the World Bank under Malpass, you see a new kind of structural adjustment policy happening where the World Bank is jumping in with budget support loans or development policy loans. And quite often it seems that a condition of that kind of support could be tax breaks for the oil and gas industry or rewriting the petroleum laws of these countries. So I'm worried about this at all levels. And I think that you know, we need to be holding our national governments, but also multilateral finance institutions, public finance institutions accountable here.
Absolutely. So the next question that was getting a lot of energy and attention from the audience came from Nilesh Pandey from Friends of the Earth, which is what kind of pressure can we put on global corporations like BlackRock to move even faster than they already are? And maybe I would tack onto that, Heffa, what have you seen that has been particularly effective in terms of pressure? What are the what's the soft underbelly to help force these institutions to move even quicker?
Yeah, thanks a lot for that question. I have sort of 2 answers to that. And one of them is going to sound counterintuitive, but I think part of the problem is that the campaign on large investors in the US is only focused on BlackRock. We've often seen that, you know, campaigning can be more successful if you're campaigning on a wider group of actors and you actually begin to try and create a kind of race to the top dynamic. So one point that I would make is that campaign, and I believe that's already happening, it really needs to also be expanded to other large investors and asset managers in the US. The other answer I would have is that, you know, we need to look at BlackRock's clients and perhaps try and go more of that route, because the institutions whose money they're managing, it's quite a different, if we can combine pressure from that side with pressure from the media, pressure on the street, I think that could be a really powerful next step in the BlackRock campaign. And of course, there's also, the necessity of sort of demasking how poor their policy actually is. I mean, it's only focused on thermal coal mining. And, if you come out with a policy like that and you're saying, oh, we're doing this for our climate, no, you aren't, because, the CO2 emissions, they happen in a different part of the industry that you're not addressing at all.
Yeah, I have to say I was struck by the recent coverage around how BlackRock voted this shareholder season. A couple of the key votes that they held up as examples of their really aggressive engagement. One of them included voting against directors at Peabody. And I think the question that really posed was, how in the hell do they still own Peabody after announcing such a big and important coal policy? Peabody's got to be one of the most ridiculous companies to own in the 21st century. And so I think your point, Heffa, is a good one, which is that they've got a long way to go. And I think the pressure that we need to bring to bear is just exposing the gap between some of the coverage of that policy and what those details actually entail. But it's a great question. I also did want to say that it's no surprise that BlackRock's big policy came out just a few short months after the Japanese government pension fund moved, I think it was $50 billion out from their management. I think money definitely talks. And so the more large asset owners that are moving their money over ESG, over fossil fuel concerns, the more big asset managers like BlackRock are going to wake up and pay attention. So I got another good question for you, Heffa. This one comes from Vanessa from Fossil Free California, and it builds on this conversation around BlackRock. How good are these coal exit pledges anyway? She's specifically interested in CalSTRS and CalPERS, who like to say they've gotten out of coal, that their hands are clean, but they have the numbers to show that they still have billions invested. Maybe you could talk a bit about the quality of the pledges you see, not just at those two asset owners, but beyond, and what you guys are focused on in terms of cleaning up some of these financial institution pledges.
So thank you for that. I mean, if an institution tells you we've basically gotten out of coal, you know that they're lying. Then they haven't really taken a look at who the coal industry is. And what people usually mean when they say we've gotten out of coal is they're only talking about companies that make over 50% of their revenues from coal mining. And that's only a small part of the coal industry. And so it's totally insufficient. And I think, for a long time, I mean, divestment campaigners, we've all said, oh, it's 15 policies, it's 130 policies. We're actually at 170 coal policies right now. And, and probably in no time we'll be at 200 coal policies, but we're at a point now where it's becoming really important to differentiate between the good, the bad, and the in-between. Because what we need are good coal policies, ones that actually cut off financing to the industry. Otherwise, we're just not going to get where we need to be. And I mean, that was one of our major motivations for doing the coal exit list, because it gives financial institutions a precise ask. We're giving them a divestment to-do list. And at the same time, it allows us to measure what policies do. And when we ran BlackRock's policy against the coal exit list, we saw, hell, this only covers 20% of the companies. So happy to do the same thing with CalPERS and CalSTRS policy, and to come up with a calculation for you that you can go back to them with and complain.
All right, we have a follow-up on this, and then a whole cluster of questions around oil and gas, where there's clearly a lot of energy. So let me ask this follow-up question from Vanessa at Fossil Free California, and then we'll bridge into oil and gas. So the question is around owning Peabody and what our take is around divestment versus engagement, one of those age-old debates. And I guess, I would answer this, and then Heffa, let's turn into oil and gas, just to say that I think it's quite clear that there are a set of institutions that could theoretically have a place in a world, a post-energy transition world. There are institutions whose future does not rely on fossil fuels. And there are institutions who are dinosaurs who will die in the Great Extinction. And I think we need to be very clear about the differentiation between pure play fossil fuel companies and diversified entities like utilities, for instance, because I think that's one of the biggest, most powerful impacts of the coal exit list that urgewald has pulled together, which is that it exposes those companies who are hiding behind the Peabodys of the world and not considered coal companies when in fact they are. And that pressure is what drives them to, drives a wedge between them and the coal industry and helps them break free and actually transition into the new world that we need to build. So with that, let's turn the question towards oil and gas. Is that something we believe? Do we think oil and gas companies are dinosaurs that will indeed die, or do we think that they can adapt and thrive in the new low carbon world that we are working to build? And so we've got several different questions around oil and gas. I'm going to ask a couple of them to you now, Heffa, but I also want to remind our audience that there are several more sessions on oil and gas coming up, including a really good one tomorrow with Kathy Hipple at around this time. So I would encourage everybody to join those conversations and ask these questions again. But we've got one from Zipporah from Stand. I'll ask kind of two of her questions in one. The first is, what do we make of their net zero commitments, Heffa? And how much credibility do we give the fact that they are transitioning? And the second is, are we giving them a free pass because they use things like CCS and BECCS as ways that they will eventually meet those 2050 net zero targets? So Heffa, give us your take. What's your feeling about oil and gas company transition and net zero targets and commitments?
Well, so I'm with Greta Thunberg on this, who said at Davos, we need real zero, not net zero. When it comes to the energy sector, that's just the fact. There are other sectors where it won't be possible to totally eliminate emissions and where we will need some kind of compensation measures. But compensation measures, they need to be reserved for that. For the energy sector, we need real zero. And I think that, it's become like, lots of people are including Tim, very happy about these announcements. And I look at them and I think this is just stalling for time, basically, and trying to convince the finance industry that, hang in with us here. We're going to, become good guys later down the road. If we actually look at the capital expenditures of big oil and gas companies, almost 99% are for further oil and gas. There's really no sign that these companies are reorienting their business in the way that they have to. And behind those net zero commitments, there aren't plans. There aren't real plans. And the CEOs who today are telling us about, the grand new ambition for 2050, they're not going to be in office. They might even be dead by 2050. They don't have to care. So I think that we shouldn't be cheering here just because of these announcements. It's really, if we're serious about climate emergency, it means we need action, and we need it at once, also from the oil and gas sector.
Indeed. I would just note that the average tenure of a corporate board is 7 years and trending down. The average tenure for a CEO is 7 to 8 years and trending down. So the likelihood of any of these net zero commitments being implemented at the C-suite level 20, 30 years from now is questionable, regardless of the quality and sincerity of the commitment. I did want to make sure, I want to come back to Heffa, your efforts on oil and gas and this oil and gas exit list I keep hearing about. But before we turn to that, there was a question that had a lot of interest from Tyler Cummings at Applied Economics Clinic. He's read in several places that there's a looming debt crisis in the oil and gas industry. How serious is this debt crisis, and how do we see that playing out? So I'm happy to step in on this one for Heffa. By no means am I an expert in the oil and gas industry, but we have looked into this a bit. And I think there's a couple of really important statistics or facts to share. The first is that the oil and gas industry by far has the largest debt exposure of all of the main sectors in the S&P 500. They have roughly $700 billion in outstanding bonds, 40% of which is considered high yield or junk, financially toxic. That was well before COVID hit, well before the financial crisis ensued. So this was an industry that was unhealthy long before the pandemic. At the same time, they only represent, as Heffa mentioned earlier, 3 to 4% of the S&P 500 by equity value. So you have a pretty dramatic mismatch between how much equity value they have and how much of a debt burden they have built. And just to compare that, the sector with the highest value in the S&P 500 is tech. They make money. Oil and gas largely does not. So there is indeed a looming debt crisis. We're seeing it play out nearly daily. Chesapeake, the pioneer in fracking here in the United States, just went bankrupt. We've had half a dozen go bankrupt in the last few months, and we expect quite a few more. The problem that I think we should all be well aware of is that in capitalism, bankruptcy is not the end. Many of these companies simply get restructured, they get bought up by private equity, and they continue in a financial zombie state. So our ultimate goal, if we care about an energy transition, is not bankruptcy. Our ultimate goal is either transition to companies or companies that are bought out and shut down. And so I think it's really important for us all to remember that while markets have significant impacts on the future of energy supplies, they are not necessarily the end goal, or at least bankruptcies are not the end goal for all of us. So with that, though, I want to turn back to you, Heffa, and ask you about the oil and gas exit list. So you've had a huge amount of impact with the coal exit list. We've seen, what it amounts to a financial exodus from the coal industry, thanks in large part to your efforts and many efforts from different groups around the world. Tell us what's going to happen on oil and gas. What's the plan for this oil and gas exit list you're building?
Well, we of course hope it will have as much influence as the coal exit list did. And we've actually been asked not only by NGOs, but by many financial institutions often, that when they've begun using the coal exit list, one of the typical comments is, so when is the oil and gas exit list coming? The first full version will be published next year, but this year we're going to do a kind of a first, a preview, you could call it, looking at the 100 largest oil and gas companies and kind of having a template which we want to test both with NGOs to see how useful it is for NGOs campaigning, whether it really captures the right data points, is based on the right metrics, but also for financial institutions, for progressive people, at least in financial institutions, whether it has a kind of information also that is useful from their perspective. And I just want to be clear that the impact that the coal exit list had, it really had it because there was a whole community of NGOs campaigning on financial institutions to adopt the criteria behind the coal exit list and to put good policies in place. And an oil and gas exit list on its own, it's not going to be effective unless it's really upheld and worked with by a community of NGOs. So this does have to be a collective effort. But I think nonetheless, the way the type of information that's offered and how it structures, it does have a huge influence on shaping policies. And that's what we want to do. Now, in terms of how quickly things are going to move, we saw with coal that most institutions that today have really good policies, they didn't do it all in one step. It took several steps to get there. And I kind of, I anticipate that we'll be seeing the same kind of thing with oil and gas.
Indeed. So Heffa, another follow-up question on oil and gas, based on your response on the oil and gas exit list. A question from Ben Cushing at Sierra Club. Should financial institutions have a different approach towards oil majors in Europe versus the US, even though we're skeptical about net zero commitments, period, there is quite clearly a big gap between what at least European majors are saying and what US majors are doing. Do you have any thoughts on any kind of differentiated response or approach from financial institutions to big oil companies on different sides of the pond?
I mean, if you begin unpacking the net zero commitments or announcements of European majors, I mean, you'll see if you look at Total, for example, it only applies for their European market, doesn't apply for, you know, and I mean, the European Union has said that, like the EU wants to be carbon neutral by 2050. So in a way, if Total makes this announcement, I mean, and it's only applies to Europe, like, they're just simply following what government is already planning to do. And so I have to say, I don't see a real reason to differentiate at this point. The other thing is, taking Total as an example again, I mean, they're at the same time over the next decade planning to still, and as all of these companies, planning to increase their fossil fuel production significantly. And I think that the point we have to make to financial institutions right now on oil and gas is really about all of these expansion projects and new infrastructure projects like LNG terminals that really lock in capital over long periods of time and lock companies and countries into a certain pathway. So I don't think I would differentiate at this point. At some point, it could be interesting to differentiate, but then we have to have somebody do something meaningful. Otherwise, we differentiate, then everybody else will just do the same bullshit thing that Total has done, and that doesn't really help us.
Heffa, this is family programming. We need to watch those comments. So I have another question from a Sierra Club colleague, Steve Hers, which is, what can financial institutions do to help accelerate the demise of the coal industry, particularly accelerate coal plant retirements? And I think this is an important question because when it comes to oil and gas, we're still very worried about expansion. And that is a very coherent, logical ask of financial institutions. But the coal industry looks much different these days. It is in structural decline, at least across the OECD. Even if there is a bit of expansion still working its way through the system in Asia. And I guess I just want to take a moment to make a shameless plug. I have a piece that'll come out hopefully tomorrow on this exact question. Frankly, I personally am quite worried about the coal fight still. I think it is far from over. And I think we do ourselves a disservice to believe our own rhetoric that the coal industry is in structural decline, not because it's not, but because the only thing that matters in the climate fight is time, and it's not happening fast enough. And so if we really take to heart the deadlines that have been put before us by the IPCC, all coal plants must be offline by 2030 in the OECD, by 2040 in the rest of the world, we need to get creative when it comes to making sure that these units come offline on time. And so there was a piece that came out this morning by E3G that assessed roughly 52% of the OECD fleet is on track. That means the other 48% isn't, which means even for the space that we've driven the most progress, we are not winning. We are not going to achieve our goals on time. And I think that's something we really need to grapple with because I think a lot of people think the coal industry structural decline story is over and we can move on, and frankly, we can't. So I just wanted to make sure we at least spoke for 1 minute about that. We've only got a couple minutes left now. These have been some really, really good questions. Great conversation with Heffa. Let's see if we can get one more for you, Heffa, before we take off.
You just had one from Steve who wanted to know how financial institutions can accelerate.
Right. Yes. So I think a couple of good examples here in the United States. There is a great paper from our good friends at Energy Innovation on the steel for fuel transition. You should look that up. Basically, interesting, innovative ways that public utilities commissions can help accelerate coal closure through innovative rate making. other great examples as well, but unfortunately, I think we are at our time. So I just want to thank Heffa, thank Tim, thank Sandy. We've really appreciated the conversation. It's been a great hour to spend with you all. And also just want to note that IEEFA will post answers to all of your unanswered questions in the days ahead. So thanks.
Thank you.
Hey, thank you so much, Tim. I should mention that one of the downsides of holding the virtual conference online here is that the time zones are impossible around the world. So while Tim was kind to record his presentation for us, we weren't expecting that he could join us at 3 o'clock in the morning. So thank you so much. And we hope that you'll stick around on the SwapCard website. You can use that to connect with other people. You can set up video chats, send messages to each other, keep the conversation going. You can also keep that going by joining us on Twitter on the hashtag IEEFA 2020. Also hope you'll take a look at the homepage of the conference website, where you'll see a feature that we are running on local leadership global change. Here we're highlighting the extraordinary work of many organizations around the world who are accelerating the energy transition in their own countries and communities. There's a short video there right now on the great work of Solutions for Our Climate in South Korea. We also hope you'll come back here tomorrow at the same time, where we'll have the next session on prospects for the oil and gas industry on a downward spiral. Thanks again,